So the one thing I would do starting today is stop treating the business like a piggy bank. And we all do it. I get it. If we reduce our income, then we pay less taxes today, this year, right? But we have to stop as business owners flowing non-essential and personal expenses through our business, even those ones that are gray areas that you could say, okay, I took a strategy summit with my partner, my business owner, or my business partner, or my husband, or something to Cabo, and we talked business. So I'm going to write off the whole trip, right? We've got to stop putting those expenses into the business because the truth of the matter is you can't add them back or adjust them anymore.
This is the Entrepreneurs United podcast with your hosts, John St. Pierre and Rich Hoffman.
Hey, entrepreneurs. Today, we're sitting down with Jessica Fialkovich, the author of Exit Factor, Increase Value and Profits for Your Business. Jessica, welcome to the Entrepreneurs United podcast.
Thank you so much for having me. I'm excited to be here today.
Jessica, what is the most important thing that entrepreneurs need to do to increase the value for their business?
So they're not going to like the answer. And honestly, I didn't like the answer when I first started my business, but the major thing that has to be done to boost value is to control your financials in your business and to increase your profitability, which is why it's tied together in the book. Is if you increase the profitability, we'll talk about increasing efficiency too in your operations, but there's a direct line to increase profitability to increase value.
Where did you learn this?
This is a really interesting story. So I was raised not to be an entrepreneur. I actually come from a very long line of entrepreneurs generations back. My father was not, because there was a failed family transition between my grandfather's business and my father, and it forced my grandfather to sell his business for basically pennies on the dollar. And so when I was growing up, entrepreneurship was a bad word. Owning a business was a bad career path. And so my parents really guided me to go into the big corporate world, which I did. My last corporate job was working for one of the largest real estate developers in the US during 2008 is when I got hired in January of 2008. We were funded by Lehman Brothers and a German bank that just happened to get nationalized in September of 2008. So that forced me to find a different path. And that's really where I found my entrepreneurial gene. I ended up founding a company with my husband. We were high-end wine brokers. So I fell into this world. We actually were going to just start by opening a cute little wine shop in Naples, Florida, but we got drug into this high-end wine world where we were brokering bottles of wine between $500 and $25,000 a bottle. I didn't even know that world existed, but we did very well in it. We built that company over 4 years and then had the opportunity to sell that company. But through that sale, I made some key mistakes, and that's where I learned all of this. I sold the company before it was ready, so I left a lot of money on the table. I paid way too much in taxes because the company wasn't structured properly. And probably the most critical mistake is I sold to the wrong person, quite frankly, because she was the first person that showed up. And because of that last mistake, unfortunately, the business failed 2 years after she acquired it. All my employees lost their jobs. My customers lost their vendors. And it's a really sad story. And so that really inspired me to go down this path and this journey of exit planning and M&A for small to mid-sized business owners for the last 15 years. But it's a long answer to the question, but that's how I got to be where I am today.
3 failures there. I don't think I caught the first one. The second one was too much in taxes. The third one was wrong person. What was the first?
Business not ready.
It wasn't ready.
Got it.
Can
we break these? Yeah, let's 3 down. When you say the business wasn't ready, what have you learned about business readiness that you pass on to others?
Yeah, so there's 2 components to business readiness. I call it the quantitative and the qualitative. So the quantitative is those numbers, the financials that I talked about. And I think in the entrepreneurial mindset, and I was there too, if you have one great year, then you should sell the business, right? But that's actually not how business valuation works. What ends up happening is there's usually a weighted average or a blend of the last 3 to 5 years of performance. And so if you think about it, if you have 2 unprofitable years and then 1 profitable year, even if it's a weighted average in favor of that highest year, you're still pulling your valuation down. Versus if you spend a couple years really preparing the financials, preparing the business and getting some traction, you have 3 really good profitable years. Now the valuation is up. And so that's the quantitative side. There's also components to it, like your books have to be in good order, which gets tossed around a lot in this industry. But what that means is that your profitability on your P&L shows as the same number as your retained earnings on your balance sheet, shows as the same profitability number on your tax return and your cash flow statement, and that money ends up in your bank account in some form. If you can't follow that trail, then usually you either get underpaid for your business in a good scenario, or your business can't sell at all in a bad scenario. So that's the quantitative side. The qualitative side, in my work over the years, we've actually identified 85 different qualitative or operational things that need to be ready in a business to maximize its value. But it really comes down to a couple buckets. One, there does need to be financial management in place, which we already talked a little bit about that, but that's about having the right team in place, and it's got to be professionally managed. It can't be your cousin doing the bookkeeping on the side when he's got time. More commonly, it's usually like a spouse that's not involved in the business. The second is the business can't be dependent on the owner. We call it owner dependency. And it's a really critical risk factor. If you think about it, if you're transferring a business and the owner still has their hands in things like sales or account management, customer relationships, even service delivery. Because if the buyer or the new owner, whoever's going to step in, sees that the customer relationships are with the owner as an individual and not the business as a whole, then that's really not going to transition well to that next person. I joke all the time too, it's not good in general, because then if you're the owner of the business, the entrepreneur, if you leave and you want to take a 3-week vacation, then the business stops working too, right? Because everything's dependent on you. And I think really what I've seen in my practice is that it's not about not having the people in place. A lot of owners do have the people in place, but they're not effectively delegating responsibility and decision-making in that role. So their people are still coming back to them for every decision.
And that was on the business not being ready side. What?
Yeah. So taxes, I find this, it's surprising, but a lot of entrepreneurs are unaware they have to pay taxes when they eventually exit their business. And I know we pay a lot of taxes along the way, so it's a sore subject for business owners in general. But when we go to sell a business, there's this assumption with business owners that we're going to be taxed at a capital gains rate. And it's actually more common that we're taxed at an ordinary income rate because of the tax structuring. So I'll say I'm not an accountant. I'm not an attorney. Like, I've just been involved in a few thousand of these deals. So that's where the experience comes from. But when you sell a small to mid-sized business, you do what's called an asset sale. So instead of somebody purchasing the stock or the equity in your LLC or your S Corp, what's going to happen is I'm going to have my LLC. The buyer will have a new LLC, and then they're going to transfer all the assets from my LLC to the buyer's LLC. And that's a practice in liability. It basically forms a brick wall between the buyer and the seller entity. So if I did any funny business with my entity, it's not going to blow back on the buyer. And it's really hard to get around that, because entrepreneurs and small business owners in general just do a lot of, I don't say that it's funny business, but we just do a lot of different things with our entities. Like, sometimes we'll invest in things outside the business. We'll take credit cards out. We may do private loans. And there's just no way for a buyer to protect against all of those potential liabilities. And so what happens in an asset sale is, instead of being taxed at capital gains, you get taxed as a blend of ordinary income and capital gains. And how that blend is determined is on a tax sheet, and it's called asset allocation. An accountant can walk them through it. But if you're not aware as a seller of how that breakdown is going to be, it's a negotiation tactic, right? Because what's good for a seller is not good for a buyer, and vice versa. So for example, if I bought a business and we applied 100% of the value to the furnitures, fixtures, and equipment, as the buyer, I could depreciate that entire business acquisition the first year. So that's a huge tax advantage for me as a buyer. But on the seller side, that's 100% tax at ordinary income. So if you think about it, you sell a business for $1 million, you go straight to the top of the tax bracket for both federal and state, and you're paying 50% in taxes pretty quickly in some states. So is that helpful?
Yeah, thanks for the overview there. Tell me about the wrong person buying it.
So when you're selling a business, I do say, and I'd say we've been talking about selling. Selling could be to an external party. It could be a family transition. It could also be to your management team, but it's some type of exit. And I think you need to keep in mind what I call it your most important outcome is. And for some business owners and for some entrepreneurs, that is money. For others, it's taking care of their people. For others, it's legacy, right? Everybody has a most important outcome. And I do have to say, like in my situation, it was money. I was still fairly young and I wanted to maximize what I was getting out of that deal to fund what I was going to do next. But when that happens, you may make sacrifices that someone's coming into the business and there may be questions that you have based on their background and experience. And do they have the ability to run this business? And so I wouldn't say that was my concern. And I actually don't think the buyer who bought my business, even though she had never been an entrepreneur before, even though she didn't have experience in the industry, I don't think any of that was the failure rate. It was that her plan was to run the business virtually and absentee. And this is back in 2012. It was not common to run a business virtually, especially not a wine business at that point. And that wasn't the right thing for the business. And so I was almost too focused on my most important outcome of the money to not see. And really, ultimately, I should have vetted more opportunities rather than just going with the first offer. But yeah.
Jessica, I hear the pain in the third one.
Yeah.
And not to divulge too much of my stories here, some of our listeners probably know it, but I built a company pretty sizable, brought on some investors. They took over the board, fired me. 2 years later, the company was gone.
Yep.
And in the aftermath of that, I spent a lot of time with myself about my ethical responsibility in protecting the people and the company that I built. And I didn't do it. And I still live with a lot of that pain today. And I hear that in your voice as well. What would you have done differently
So
on
I
number
think,
3?
I think it was more about education and understanding. And this is why I've gone down this path with Exit Factor and why I've dedicated the rest of my career to this is I think I was, and most entrepreneurs are very well educated on startup growth of a business, but we really don't talk about this exit process. And and I did the same thing, keep kicking the can down the road as, oh, it'll happen one day and I'll deal with it then. And the reality of the situation is this isn't something that you can learn or deal with in a 6-month process. There's years leading up to it that you have to design your business and ultimately prepare yourself as an individual for that transition. And that's what I would have done differently. Is in the back of my mind, I always knew I was going to sell the business. I told you the story, I just landed in the wine industry. There was no plan to stay in that for the rest of my life. It was always a short-term business for us. And so there was really no excuse for me to put my head in the sand and think that I didn't need to learn the process. I just didn't know where to go to learn the process and learn what I needed to do.
I want to dig a little deeper.
Mm-hmm.
In item number 1, your business not ready. By the way, I'd love to get a copy of the 85 qualitative things that will help increase your value. So I don't know if that's something that you would provide our listeners, but I'd love to see it. But I understand. Here's the checklist. Here's the things you got to have qualitatively to increase your value. Quantitative. You need to have tight financials and all the different elements. Here's what you need to have to increase your business value. Oh, and by the way, when you're selling those businesses, here's all the tax things you got to consider. Got it.
Yep.
I'm thinking about potentially exiting a business in the future, business A. What should I be thinking about and doing due diligence on and research on the wrong person? Because it's hard for me to tell who the right person is. They're going to say all the right things. They're going to write the check. That's ultimately what I'm selling. They're giving me the value I need. What do you suggest owners are looking to sell their business do to make sure that they don't sell to the wrong person? Because I am concerned about that as well in the future when I do sell my business, because I've been hurt and I've hurt people behind. And I don't want to do that again. How do I evaluate that decision?
Yeah, I think the biggest common mistake is when you fall into a situation where you're selling it to the wrong person is exactly what I did, is you're only vetting one person. And this is actually a common practice right now. I call it the private equity game because private equity firms are the most common offenders of this. But they'll get private equity or just individual buyers will get a list of businesses that are over $1 million in revenue in an industry that they're interested now. And you can get that from Zoom Info or anywhere now, really. And they'll send out, with the help of AI, a seemingly very custom and personalized email to all of those owners and say, I'm very interested in buying your business. And what their goal is to get a business owner hooked in with them and not have the business owner take it to market, because they know if they take it to market now, honestly, it's an open bidding, so they're probably going to pay more. But there's also going to be an interview process where the owner is going to meet with different buyers. They're going to meet with different management teams. You're going to have the opportunity to ask questions whether that buyer is a good fit for your company. Because I think your question, really, there's no real way generally to know. It's really specific to that business. I'll give you another example. I was involved in a sale once, and it was a roofing company. And the roofing company was owned, the previous owner was very lackadaisical in his management. The guys went out and had a great time on the side. They would go to bars, they would go to some other unsavory places type stuff. Not that one is good or bad, but the new buyer that came in was a very devout Christian, and he didn't believe in drinking and some of those. So he took away all those bonuses and all those parties and everything. And so the business lost 100% of their sales team in the first 6 months. And so it's usually that kind of stuff. It's a more of a cultural fit than there's these check the boxes thing. And I don't think you can see whether someone's a good fit for your organization or not unless you have the ability to interview multiple people. Just like a buyer is going to interview multiple businesses. One of my friends that runs that private equity strategy, just to give you some insight, he sends out about 6,000 emails per year to have 686 conversations to close one deal. So all those owners feel like he really wants my business, but meanwhile, he's just running a pipeline, right? And
Yeah.
the owners should be running their own pipeline of buyers and not getting so starry-eyed like I was about this one buyer that's interested in your business. The truth is there's multiple buyers and multiple paths to exit.
Yeah, I love that. And so what I got from that was run a process. Don't just take the first person who calls you. Get
Yep.
multiple people looking at your business. And what you'll get there is a variety of lower bids, mid bids, high bids, whatever it may be, but interview them all, understand or interview the top candidates that are there against each other. One thing that I implied from what you said too is look at their track record. That's one thing that I failed big time. I didn't look at a track record. I would have found some things that didn't look good, that look nasty. If they are investors in business, they probably have done this before or they have a track record. Go take a look at that. Past references, cultural fit is a big one.
Mm-hmm.
The one thing that also you would do with employees sometimes, that if it's an open process and your company knows what's going on, is have your team maybe get involved, certain high level members of your team, to potentially see what they think at a dinner or just get a feel for what's going on would be another thing, because sometimes they have a spidey sense as to what's going on. So that's great share. I appreciate that. It's interesting that I had once heard this, and it resonates with what you're saying, is the question was posed to a business group, who is your customer?
Right.
And ultimately the customer is the person who's going to buy your business.
Mm-hmm.
That's the customer. And how do you prepare your business for that customer along the way seems to be part of the journey. So now when you work with entrepreneurs,
Mm-hmm.
what is the process? I'm assuming you work with entrepreneurs. You have a book.
Yeah,
So maybe tell
correct.
me a little bit more about that. What do you do to help entrepreneurs prepare for exit?
Yeah, so we have a consulting practice called the Exit Factor. We're actually a franchise operation, so we have 52 offices nationwide that do what we do. And typically the first thing we do is we do what's called an exit assessment. So those 85 criteria, we actually evaluate the businesses that we work with both on that quantitative side and the qualitative side. So quantitatively, we look to see, are their books and records are in order? Are their profit margins in line with where they should be for their industry and their size? And then we run them through our 85-point checklist on the qualitative side. And ultimately, what that shows us is what's the business worth today? What are the metrics we need to do to get to our goals? But also, what are the qualitative issues that we need to resolve? And that lays out our roadmap, our timeline, and our plan for what we're going to work on with them throughout that consulting process. Sometimes it'll take 6 months for a client. Sometimes our clients have a little bit longer runway, so 3 or 4 years, and usually they have higher goals. So instead of trying to boost profitability 25 or 30%, we might be trying to double it over that time period, which then also obviously aligns with valuation as well too. But each of the engagements is a little bit different because I always say we don't need to make a business perfect. We don't need to fix all 85 things. There's usually like 3 to 5 levers in each of the businesses that we need to pull, but that gives us the base foundation of where we're starting from.
Got it.
Yeah.
So exit factor is the franchisor,
Correct. Yes. Yep.
and you have 52 franchises across the country.
Yep.
And what's really appealing to me in that business model is after you go through those 85 areas or the quantitative areas, it must be so not easy. I don't want to diminish it, but in small business to be able to go, hey, we're going to work on this and this. You're going to increase your value by this. It's well worth hiring us to come in and help you do this. So I love that.
Mhm.
What kind of person what kind of franchisees do you guys bring on? Is it people with some financial background? Is it CPAs? Is it within, could financial bookkeeping people have a franchise? Like I'm very curious about the franchise model here because it seems like a very
Yeah.
appealing business.
Yeah, so typically our franchisees come from one of three backgrounds. The first is an exited owner, so an entrepreneur who has built, grown, sold their own business, and they've been through this process. Because it's interesting. Yes, we have to have a financial background, but if you think about what we're doing, we're really doing change management and we're changing decisions. So to your point, the things that we're doing in the business, they're not easy, but they're simple. But they're sometimes very hard decisions to make. So let's take profitability, for example. A lot of times, most the large majorities of the businesses that we work with are under profitable when we pull industry and size data. And if you look at most businesses, there's major levers you can pull with profitability. If there's a product-based business, you can pull cost of goods and stuff like that. But if it's not, if it's service-based, we're usually looking at people. And so it's simple to look on a P&L and say your sales director is not performing and we need to restructure the position, fire that person. But it's hard because maybe that person is the owner's best friend and they've been in business together for 25 years. So there's simple decisions that most owners would be able to make logically, but they need the support. And so that exited owner has been through that process. And so they have the emotional fortitude and they know that they can be authentic with their clients because they've done those things. So that's the first, like what I call avatar of our franchise owners. The second is somebody that has done similar work at a much higher level in terms of business. So we have people that have done change management and M&A consulting at McKinsey, Deloitte, some of the big four consultants, but to be quite honest, they were sick of working with big Fortune 500s. They were sick of the travel schedule, and they're much more passionate about helping small business. And then the last is a professional that's been in and around the exit world in a like fractional CFO capacity, maybe a business broker capacity, but they want to be a little bit more hands-on with clients and less transactional. And so they've come from that component. We have a few CPAs. I love to say our CPAs are personable and they have a personality too that have come to the network, but it's a smaller percentile.
What's the ballpark number of exits that Exit Factor has participated in?
Yeah, so professionally over my career and with the exit factor methodology, we've been involved in over 2,000 exits across 75 different industries. So,
And what's your ballpark on a percentage or rough number on of the 2000? How many of those were franchise owners themselves, part of a franchise system?
oh, you know what? I don't know. I will say we work with franchisees much more frequently than a lot of other business coaches and consultants do because we come from a franchise background. So I've been in and around franchising for almost my entire career. My now business partner, who is a co-owner of Exit Factor, he is the CEO of United Franchise Group. He has been in franchising, he's second generation for 40 years. So we have a lot of exposure to franchises and just the nuances of when you're working not just with a seller or a buyer, but also the franchisor and franchise agreements. But I don't know the exact percentage, but it's definitely larger than a lot of other organizations. Yeah.
And based on your experience having sold franchise owners within a franchise system, what's different that
Mm.
you work with them differently? One of the reasons I ask is we have a portion of our audience who are franchise owners themselves,
Yep.
and they're probably wondering that. I am too.
Yep.
What's different about how you would work with them to exit other than the typical answer, oh, we have to take the franchisor into consideration? Okay, great.
Yep.
Like
Yep.
what is different about what they should consider or how they would go about the 85 or how you look at them different? Is there anything different?
There is. And it is the answer is we have to take the franchisor into consideration. But I'll give you a few more tactical
Yeah,
ways of
please.
what we do that, right? So there is a third party in that exit, and it's the franchisor. And so we have to do a deep dive into the franchise agreement, both the one they signed and the current one that's available. So when you do that asset sale that I explained, that new owner is going to sign the new franchise agreement. And so I'll give you an example of a franchise that I've personally been working with for the last 3 years. And they signed their franchise agreement 25 years ago. The royalty structure has changed. They got a sweetheart deal with royalties, so it's capped. The new owner is not going to get that deal in the new franchise agreement. There's other things that have changed in the franchise agreement over 25 years. Obviously, tech fees have gone up, some marketing fund contributions have gone up. And so those are things we cannot control and we cannot change. We could negotiate with the franchisor till we're blue in our teeth, and it's just not going to happen. So our approach is, okay, now we have, and we saw we had to make up about 8% differential in net profitability, what the new owner was going to say. So what we're going to do is we're going to look at the P&L and we're going to try and boost that profitability. We already had a goal of 3% for them to get them back to average in their industry. Now we've got a goal of 11. We've got to make up 11 points because that new owner, that's the P&L they're going to be operating off of. And so that's more of like the tactical of like, why is it important to bring in the franchisor? It's also important to understand their process. Some franchisors have a resale department, and that's a huge benefit to the franchisees because they may not have to hire a broker and have all those transactional costs. But those resale departments might need a little bit of help along how to sell it. What's the story to tell? Things like that. Other emerging brands might not have that type of resale process dialed in. And we want to bring in a third party like a broker to help control the process so it moves along. So,
do you have franchisors who work with you and contract with you to consult on all of their franchise owners' sales? Is
we're
that a thing?
we're starting to do that. United Franchise Group owns about 11 brands. And so we work with the brands that basically are sister companies, but we are starting to court and work with some other brands, specifically emerging brands that don't have a well built out resale department as well too, because we have that experience in the past.
And you will not find candidates for a franchise owner or anyone who's looking to sell necessarily. You'll work with them on the process of being prepared to sell and potentially vet candidates. Is that correct?
Correct. Yep. But we're not going to act as a franchise broker. We're not going to act as a business broker to go out and find those. Part of our process, we help our business owners identify who could be potential candidates to buy the business or avatars, at least, to pass that along to their brokers or to the franchisor. So they're more fully prepared, but we're not going to run that process ourselves. So that's a whole other skill set, right?
Yeah.
Yeah.
If we had an ideal ramp up time for a business owner to prepare for optimal sale, what is it? And then follow-up question is going to be, is it different for a franchise sale?
So it's not different for a franchise sale. And I'm going to give the standard answer of 3 to 5 years, but I'll explain why. So if we remember back to the beginning of the conversation, I said that the valuation is not dependent on one great year. It's based on a weighted average of the last 3 to 5 years. And so that's the ideal time frame. Also, I find it takes typically a minimum of 3 years to get all the operational things in place and the tax structures in place. There's actually one tax strategy that you have, if you're going to pursue it, you have to have it in place for, it was 5 years, but the new law just changed it down to 3. Now, I'll say in the beginning, it's a little bit less intense. So our clients that are 5 years away, we may be meeting with them on a quarterly basis and they have a shorter checklist to get through. Once we get in within that 18-month time frame, it becomes more of like a bi-weekly type check-in and more intense in the process.
Can you provide a fast, maybe not entirely accurate, but for speed, way to value the business?
So I don't like to do it because any fast, we call it back of the napkin valuations, and there's AI now, there's been calculators on the internet. If I'm going to be honest, they're highly inaccurate. So when you want to look at really what the value of a business is, we talked about what the quantitative is, and what that dials into is what is the EBITDA of the business. So what's that weighted average of the EBITDA? That's usually pretty easy to calculate, right? The multiple is the harder part. So you hear lots of things tossed around. I'll give you an example. I was working with a healthcare company and she said to me, the owner said, I heard the multiple in my industry is 6 times EBITDA. That's not accurate. There's a range of EBITDAs, right? So when I pulled the range from the 10th percentile to the 90th percentile, throwing out the outliers, the range for her size business in healthcare was 1.2 to 18 times. So that's a huge range. And so all of these back of the napkins, calculators, all they're doing is they're just giving you the median or sometimes the average multiplier. And to apply that to every single company in an industry, and sometimes it doesn't even take into account size because there's different tiers, produces these highly inaccurate numbers, and it sets poor expectations for the owners. And that's where that 85 qualitative scorecard comes into play with us, because we use those qualitative factors to determine, are they 10th percentile or are they 90th percentile, and give them a more of a dialed in version of what the multiplier should be than just everyone's average, which is basically what all those calculators are saying.
Oh, interesting. So you use your 85-point list, and hypothetically, let's say you're calculating if are they in the 85th percentile. Ballpark, it's 1% per one of the bullet points of the 85. So
Yeah.
you're going, hey, if you're missing half of them, you're probably around the 50th percentile.
Yeah.
We could work with you to be in the 60th percentile. Here are the 10 things we'd want to work on to be able to get there.
Correct.
So that's where, because my follow-up question was going to be, how do you factor for what the multiple would be? And you answered it in your answer already, which is we look at the 85 things. The more of the
Yeah.
85 things you have, the closer to the 90th percentile you have. The fewer you have, the closer to the 10th. Is
Correct.
that accurate way to look at it?
That's an accurate way. Yep. And it's a little bit more complex than that. Sometimes we throw out some of the 85 that aren't applicable to certain industries. Sometimes we rate one of the aspects higher because it's more important in the industry. But yeah, baseline is, if the 85 things, you rank higher. If you don't, yeah.
If there's one thing that a business owner who's listening can do today, by the end of the day, what would you instruct them for that to be? And then the follow-up will be, what's one thing you believe they should commit to that they can't necessarily do today, but
Yeah.
you should commit to today moving forward?
So the one thing I would do starting today is stop treating the business like a piggy bank. And we all do it. I get it. If we reduce our income, then we pay less taxes today, this year, right? But we have to stop as business owners flowing non-essential and personal expenses through our business, even those ones that are gray areas that you could say, okay, I took a strategy summit with my partner, my business owner, or my business partner, or my husband or something, to Cabo, and we talked business, so I'm going to write off the whole trip, right? We've got to stop putting those expenses into the business, because the truth of the matter is you can't add them back or adjust them anymore. And so you're devaluing the business for every single thing that you put through the business. That's non-essential. So that's the first thing I do today. And then the commitment, I would say, is that, just like you think about it, when we start our careers, most of us start an IRA or a 401k. And we have this long-term vision of, when are we going to retire? How much are we going to need? And we're going to work towards that. For entrepreneurs, it's usually different, because part of that component is, oh, we're going to exit our business for X amount, and that's going to go into our retirement. But if you think about it, we never work on that process. We just think it's going to happen. So the commitment would be, just like a lot of us have strategic thinking time or planning time for how we're going to grow the business. If you can just spend an hour a month to think about, what is this long-term exit strategy? And I always think about, challenge business owners to think about, what's the target, right? Target meaning, when is the target? Is it 5 years away? Is it 10 years away? And what would be my target goal valuation? Having an understanding of that. But also think about, what's the backup plan? Because one of the reasons that I'm so passionate about this is that 95% of owners do not exit on their timeline. And the reasons they don't exit on their timeline is because, at the end of the day, entrepreneurs, we're just people, right? So we have things hit us like illness, injury, family changes, other opportunities, and that's what precipitates most exits. And so that backup plan is super important. And ultimately, if we're spending that hour a month or working on improving the valuation of our business over time, if one of those things happens to us and we're forced to exit, we're going to have a much better outcome because we thought about it instead of just letting it happen.
If you had a number of our listeners who are interested in learning more about the exit program you've got, or the franchisor side, or you personally, like, what would optimal be for you? Are you interested in people reaching out to you for some next steps, or where would you funnel that interest?
Yeah, I think to me would be the best step. And then I could connect them with people in our network that are a good fit. I'm most active on LinkedIn too, if people want to learn more, get to know me personally and professionally, or they can reach me at jessica@exitfactor.com.
Jessica, thanks for joining us.
Thank you so much.
Stay tuned as John and Rich unpack today's conversation.
Biggest common mistake is vetting one person. I can see how it would be so easy. There's somebody who's interested. They have money. You can exit at what you want to exit for. Things are continuing to go well. It'd be really hard, John, to go, hey, time out. Let me actually talk to some other people real quick. I can see where that'd be very difficult.
So let's marry a couple of concepts. One is one of the reasons why someone looks to exit their business is because they want to extract the value from it. So they're trying to get what the business is worth out. And you asked a very interesting question, which is how do we calculate what a business is worth? Like, what's the quick way of doing it? If you had asked me the question, her answer was very appropriate. It does range and it doesn't really matter. It's hard to predict. But the truth of the answer at the end of the day is your business is worth what someone's willing to pay for it. That's what it's worth. And what somebody's willing to pay for it varies. And so if you're selling your business to extract the most amount of value you can from it, and what's your business is worth is what somebody's willing to pay for it, ultimately, there are a lot of people who just go with that one person. The one person who arrives with the check and says, I'm willing to pay for it right now. Here you go. Or even if you run a process, go with the highest bidder. But that potentially can violate the third issue, which is you've created this thing, blood, sweat, and tears, multiple years of building something. You built the team, you got it all built up, and then you just take the highest bidder and they destroy the culture. They destroy everything you've built. And at that point, you have the money in the bank account, Rich. You're not as worried about the money anymore, but you live with a sense of guilt. And boy, do I connect with that feeling of entrepreneurs when you go to sell your business, vet out the people properly. Because the last thing you want is to live with guilt that you sold your business to the wrong person. Wow. That to me and Jessica's three things really connected hard with me. And it's something that all entrepreneurs need to consider. Don't just take that first person showing up.
I was not expecting that she was a franchisor. And they have 52 locations. They've done 2,000 of these. I could tell the depth of experience that she was answering with, and the speed of her answers and the simplicity with what she answered did not lack depth. What an interesting model to have then that as a franchisor and presumably across many states when there are 52 of them.
Well, Rich, I started getting really excited when you asked specifically, what's the one thing? Or sorry, I think I asked, what's the one thing? Right off the bat, what's the one thing entrepreneurs need to really be focused to increase their business value? And she said, control of cash, financials, profit, really that controllership of your financials. That ultimately is where a lot of the work is spent. The 85 things on the qualitative are critically important as well. But you and I have both seen a lot of balance sheets and P&Ls. And again, even in my own companies, where they're not clean, they're not tight, they don't tie properly. The entrepreneurs focus first on sales. I need the revenue. Oh, then I got to operate the revenue, and then I need more sales, and then I need more. But the accounting's the last thing on the list. They assign that out, they dole it out, and it becomes a mess. And that ultimately is one of the biggest factors that affects their enterprise value. And whether it be the book Scaling Up from Vern Harnish, he called it out specifically. The last thing entrepreneurs worry about is keeping tight books. And if you're looking at your P&L and balance sheet and it's not crystal clean and it doesn't tick and tie to everywhere, you can't even outlay strategy on how to be more profitable because you don't even know where things are. It's so critical to do that. Top level, top grade, whatever you want to call it, your bookkeeping, financial part of your business, it will help you. And even if you're using AI and things like that, you send AI garbage information, it's going to give you garbage back. If your financials are tight and everything you do is tight, you could actually have AI help you with strategy and help you figure out how to be more profitable and use things like that. But it all starts with garbage in, garbage out. Get your financials right.
And it's interesting, you were saying increase the revenue and then we need to operate with it and then we need to increase more revenue. The part where she ended on was where you go, increase revenue, then we need to operate with it. Oh gosh, we need more profit. So we're going to claim some marginal expenses. And that was the thing that she said, start to do that immediately. Today, this afternoon. Start cutting some of that stuff out so you could sell the business at the right price, because you can't actually legitimately add it back. So I can see that being another part of the thought process of we need more revenue, we need to operate at the right expenses, and let's throw some extra expenses in there.
Yeah. Rich, I have a different view of this, similar to hers, but different, which is I agree 100%. The business to which you are looking to build to ultimately sell to somebody should not have quasi maybe business expenses that you're running through your business, even though they might be personal expenses. That's not where that belongs. Your business financials should be tight and should show an accurate picture of your business and should be really that business, that unit that you're trying to exit and sell. That doesn't mean that you shouldn't have another LLC to which you do consulting or have real estate holdings in or do other things. Do things in that entity if you want, that you're not looking to exit or sell to somebody else as a business unit. But if you have a business you're trying to build to sell, keep it tight and keep it clean. But I'm a high proponent. I have multitude of LLCs for different purposes. Real estate, consulting business practice over here, a rink over here, different LLCs to which I may not be looking to sell those, maybe ever. I have an LLC I have with my family that we do a whole bunch of different things in and investments in and everything else. I can run expenses through that. I don't have to do it through the business I'm trying to sell in 3 years. So I agree 100% with her point. But if you're looking for the tax advantages of owning LLCs, there's other ways to do it in other vehicles. You don't have to do it in the business you're looking to sell. That gets messy, ugly, and unnecessary.
Great point. And then I think the last piece she ended on, have a target for that exit strategy and then have a backup plan. We could use that as a universal principle. You can have that as a universal principle when people are putting together a 30-year life plan, when people are putting together a 3-year business plan. Have a target and have a backup plan. Think of the contingencies, what may come up, and then what's the backup plan if those things do come up. So overall, this was an excellent conversation with Jessica. I learned a ton. I'm sure our listeners did too.
Yeah, absolutely. We look forward to having more guests like this, like Jessica, next week. Please join us back on the Entrepreneurs United podcast. Thanks for coming.